Lane, thanks for being on the show. We are excited to have you as a guest for a second time now. Last time you were here, your net worth had jumped a lot. How's it looking these days, realizing it's been tough in real estate with interest rates high? And how's family life treating you?
Thanks for having me, guys. Normally, when you guys have repeat guests, their net worth increase. Mine's went the opposite way, but yeah, definitely lessons learned. And yeah, here we are. I got another kid. More future liabilities, or I think that's what they call it on the balance sheet.
Can you update us on what's happening in commercial real estate right now?
We're in a lot of these like commercial properties, and in commercial real estate, prices came down 20 to 30% off the peaks of what we now know was 2023. I can get a little bit more into details, of course, but yeah, when these properties go down 20%, because you buy real estate with leverage, oftentimes, let's just call it like a 80% loan, you've only got 20% of equity in there. So when it goes down 20%, you don't lose 20% of the money. You've just lost 100% of your equity there. So in real estate, I think I rode a good wave from 2009 to 2022, 23. Still going to keep doing it, but maybe I should have been 90% real estate. If you're not forced to sell, you don't sell. I guess the analogy somebody told me the other day is if you're buying a Honda Civic for 25 grand and for some strange reason, Honda Civics are now being sold for 10 grand, you don't sell the damn car, right? Unless you gotta put food on the table. Maybe if that's a little bit more of an extreme example. The reason why these prices came down so much in commercial real estate, which is detached from residential real estate, is because of the loan structure a lot of these commercial properties are purchased at. I think most people understand that residential real estate is bought on 30-year amortization, 30-year loans. In commercial real estate, especially if you're doing like a value add strategy, you're typically taking a bridge loan. Could be a year, could be a few years, could even be 4 or 5 years. But rarely are you getting fixed debt at above 10-year plus or even 8-year plus. So here's what happened. 40-year high of interest rates, quickest time in history, surprised everybody. All the buyers left the market. And that's what dictates prices, buyers and sellers. I, as a buyer of real estate myself, stopped buying because I couldn't make the deals work because the interest rates were just too high, the holding costs. So me and pretty much everybody, majority of buyers out there left the market, which is why prices came down so much. And you combo this with the loan terms, that's what's also what made the prices come down in commercial real estate. If you're not forced to sell because your property is cash flowing, because you're able to implement the value add enough, then you keep holding on to it. We just sold a couple of them recently for some gain there, but they've reached the end of their life cycle. And especially when you typically go into commercial real estate, there's some type of value add play where you're renovating units. And if you've already renovated the units, there's really nothing much to do there. And it really is reaching that holding arc where you just sell it. And as opposed to waiting for the market to recover. The idea is if you have money in the property as equity, you always got to ask the question as an investor, would you rather have the money in that asset or in another property where the potential for value add hasn't been tapped yet? Would I rather have my money in this property where we've already renovated the units, bump rents as much as we possibly could, or take that money and put it into a new potential one? Would I rather bring LeBron James on my basketball team, or would I rather get Luka Doncic, who's like a decade or two younger, right? It's the same concept. And that's where a lot of people are, I think, stock investors here. I'm not so much myself. Every day you choose not to sell your stock, your NVIDIA stock, is another day you've chosen to buy it. So that's kind of same approach I have with some of my properties here.
What do you tell investors who are worried about values dropping?
Yeah, I can't say too much for residential real estate. I'm not in that world. I will comment that, like I said, the prices are dictated by buyers and sellers, supply and demand, as we all know in economics 101. And in residential real estate, you have this sort of phenomenon where a lot of people got these sweet loans at pretty much 0% from 2018 to 2022. And in a way, they're prisoners to their own loans and they're not moving. And there's a lot of old people that are just staying put because they don't want to sell the property because they've exceeded their $500,000 home sale tax exemption there. So you have a lot of these people not moving. And what that creates is a situation where there's not too much supply, right? There's not too much inventory on the market. So the thing is, we don't know if the demand is truly higher than normal. We just know that there's more people trying to buy houses than there's supply. And like I said, we know that there's not so much supply and inventory on the market. I think everybody talks about there will be a housing crash. We don't know, but if more houses come on the market, then that could finally test a correction downward. It's kind of like you just stack sticks on a camel's back, right? At some point, it's going to break the camel's back. But I don't really anticipate that happening because generally speaking, we're in a housing shortage. But again, that's the furthest comments I'll make on the residential side. I'm more on the commercial side myself. What I can quote, some of these industry data houses like Arbor, right? Arbor is one of the biggest multifamily lenders out there. They just came out with the report last month where they said the first quarter of values increasing since 2023. So that was the first positive headline I've seen in these industry publications. I guess speaking for myself anecdotally, I've seen one of my properties go from like the low $20 million range to the mid high $20 million range. I'd like to say that we've done a lot of good work there, bump rents, but really not. It's been a flat line there. So to me, that it's higher than a 10% variance fudge level, right? Because you have to take appraisals and with a grain of salt. But to me, I think that's one clear data sign that we're heading in the right direction. But yeah, as interest rates continue to fall, that works its way more to prices increasing and rebounding from here on out.
What part of commercial real estate are you most focused on today?
I'd say there's probably like a handful of different categories of commercial real estate. I mostly play in the residential real estate apartments. So specifically speaking, workforce housing. So stuff for the average guy, the lower middle class. If you're thinking like rents that are $800 to $1,200 a month, definitely not the luxury class A sexy stuff that's $3,000 a month in California or $2,000 out in the Sunbelt states, but stuff made for the glut of the American population. At least the way I see it as an investor, you always have to have some type of thesis. My thesis is the rich are getting richer and the poor are getting poorer and the middle class is reverting back to the lower middle class. And I think that's going to be an underserved demographic out there needing these types of housing, these apartments. But yeah, there's lots of other asset classes out there, mobile home park, self-storage, luxury developments, and then office out there. I'm mostly in that multifamily workforce sector.
What lessons have you taken away from the last couple of years?
Whenever you go through a painful time, unless you just totally ignore it, there's always lessons learned through the process. I would say having a huge concentration in commercial real estate, not never giving any investment advice. That's what really got me to this level, right? You don't concentrate, you'll never get enough to get you to where you want to be in a shorter amount of time within a generation. I kind of prescribe to the theory that, yeah, diversification is great once you have a few $1,000,000 net worth, but it's hard to concentrate to get there. And additionally, I am an operator of real estate, right? I'm not just a passive investor too in this stuff. Anybody who runs their own business knows that you have to have 110% running your business, improving your systems, then to also be trading options on the side. I guess what I'm realizing is that there's different market cycles to everything. So there's a stock market cycle, there's cryptos, goes through a lot shorter market cycles, and then commercial real estate and residential real estate. Like I said, I don't think we've seen the correction in residential real estate and stocks yet, but typically, just like commercial real estate, they typically run on like an 8 to 12-year cycle. That nothing said you can't have a double correction, but I guess that would just be one big one at the end of the day. But you just never know. And I guess that's my viewpoint is I don't have a crystal ball. You have to come at it with a assumption that you're learning every day and you can never time the market. And so I think what I'm trying to do in the future is to be in different asset classes that are somewhat uncorrelated with each other, or this idea of uncorrelated assets. So commercial real estate is somewhat disconnected to the markets, although is very connected with interest rates. Obviously, there's some connection when interest rates go down, stocks go on a nice run, at least in the short term. I think where I'm looking in the future is I need to be in more private equity, venture capital types of investments in the future. I personally don't do any stocks, bonds, mutual funds. I consider those retail investments, and I prefer to invest more directly to the source.
Tell us about your new book. What makes it different from other investing books?
Yeah, so I graduated college in 2007. At that time, I was super into the Roth IRA, maxing out my 401k, doing everything my parents taught me and the Vanguard guy taught me to do, which is go into these index funds and ETFs. And then I started to work for the man, and I didn't like it because I was a construction supervisor. So I was telling guys in their 50s and 60s what to do as a young kid in his 20s. So I didn't really care for that, but I made good money and I was able to save a good amount of money every single year, at least like 20, 30 grand per year. So I took that money and I bought a house to live in because that's what we're all taught to do. And I was brainwashed at the time. So I bought that house to live in, but because I was traveling all over for work, I, on a whim, kind of decided to just rent it out. And the rents were like $2,200 a month. My mortgage was $1,600. So I didn't know about like all these expenses that you had to pay, repairs, maintenance, property management fee. I just knew, I was like, wow, I was like making this cool beer money with the differential between the two. But then this was back in 2009, 2010. I got more educated on it. And I was like, wait a minute. I'm making money with the cash flow on the property, like I mentioned, the tenants paying down my mortgage. So I'm getting equity build up there, the appreciation on the property, which is leverage, and the tax benefits, right? So when I compared it with what I was getting in the stock market, I was like, wait a minute, why would anybody want to invest in the stock market and do that type of stuff? And mind you, I was working my engineering job at the time, wasn't really putting too much effort into it. I was just buying and holding at the time. And I had a professional property manager that I paid 10% of the rents to. So this allowed me to focus on just working my engineering job. And in case you missed it, I was homeless at this time where I just lived off the company dime, went from hotel to hotel. So my savings rate went from I think like 30 grand per year to like over 100 grand because I also made a lot of money with those hotel points and those airline points too. There's months where I spent like $100 of my own money. So all this money for like maybe 4 or 5 years went straight to buying little rental properties. And by 2015, I had 11 rental properties. The first few units were in Seattle, but then eventually I would buy properties in Birmingham, Atlanta, Indianapolis because they had just better rent to value ratios out there. I wrote this book called The Wealth Elevator. I think it's very unique than any other books for a couple of reasons. First, this book is mainly written for accredited investors. And what it really does, it talks about the different stages of the wealth building cycle. I think a lot of books are written out there for guys getting started in credit card debt, the Dave Ramsey, Susie Orman type of books. This is definitely not the book. If you're looking for ways to budget, save money, I'm definitely not the guy to listen to, right? Like I had a good job, right, initially. And I started on the first floor of the wealth elevator, which is buying little rental properties. But in the book, I described these different levels of the wealth elevator that I put into different floors. Like I said, in 2015, I got up to 11 rental properties. I started to interact with a lot of other accredited investors. And up until this point, I didn't know any accredited investors. My parents never even owned rental properties. So this world was all new to me. And maybe because I was young and I listened, people took me in and I realized like how accredited investors, people with $1 million or greater did things with money, taxes, and investments. I kept hearing these best practices over and over again. And it got me frustrated because it was like the complete opposite than what my parents taught us and what we're all taught to do. This is where I realized this was the curriculum on the second floor of the wealth elevator, right? When you're on the first floor, you're broke, you might make a good salary, but the name of the game is just to keep buying little rental properties until your net worth gets to close to 7 figures. And at that point, you become a bigger target for getting sued, right? Because you got $1 million and you value your time more than money in a way. So this is where I got involved into the syndication and private placement world, investing in commercial real estate. And what really got me was like the community and like the people who did this. Like I never knew that there was this shadow world of wealthy accredited investors investing in this way. And it went well beyond what the little mom and pop rental property owners were doing. But yeah, I also talk about the third floor and the penthouse in the book. I've been lucky enough to interact, buy a lot of properties from wealthy people out there. Some people would call these people in the family office level. And these are people who are $100 million net worth. It usually takes you a few generations to get there. But to see how they do things is very different than what people who have $2 million do. What I started to do is I started to break down exactly, a lot of these guys will have an in-house CPA, in-house attorney, like at least a fractional person where they may buy out half of CPA's time. And then they'll also have people on their deal side, people to search out deals for them. And then a big part of this is they're very well networked. They may work with other family offices in a multifamily office environment where they're co-sourcing deals with each other and underwriting them together. This is, what I talk about in the book, but it's mainly written for that accredited investor who's trying to get to that next level. But I always feel like it's important to know what's two levels above you. And I think a part of it is I wish what I knew now, what I knew then, the theory. But for example, the guide getting started for people just getting started buying little rental properties. And I always tell those guys, like, don't buy these duplex quads, right? If you guys make a good salary, you're going to blast past accredited investor status pretty quickly. And you don't want these like pain in the butt quadplexes that nobody wants to buy. Sure, they're better than cash flow, but there's a lot of reasons why you're just not going to get the nice pop in price on those types of assets. But these are a lot of things like I never had a rich uncle that kind of tell me what to do.
How do you split your time between running your own family office and educating other investors?
Yeah, I've never done a time study on myself, but I try to keep it half, where half of my passion project is we do a lot of events for accredited investors, because that was my big aha moment when I got started was I never realized people invested this way. And a lot of these people are very generous, cool. So we have a mastermind for accredited investors. We do events from time to time. People come to Hawaii where I live. And we do a lot of online events because a lot of our folks are pretty busy. But on the other side of the house, as you mentioned, I operate as my own family office. And the job of a family office is not to trade time for money, but to invest the money that I have into good projects. So part of that is going out there and sourcing good deals directly with the person who is doing the deal operator sponsor. Now, this is where I've cloned myself and hire a team to do this. One little sneaky thing I did was during the pandemic, I started to go and just put out job postings on LinkedIn for people who already work for these very wealthy family offices. Part of it because I had learned that these family offices will hire deal finders for them. Like your small real estate world, you've got the little wholesalers that find properties for the house flippers. Similar framework, these family offices will have people who are well connected that know all the players, the deal operators, where the deals are going down. And they will bring the deal to the family office, the patriarch of the family, to make a decision. Sometimes they'll also offer underwriting services and asset management too. But make no mistake, the family office is not the person running the deal, right? When we mean asset management in that sense, they're the one that's harassing the deal operator for different financials and making sure that they're doing what they're supposed to be doing. This is essentially what I've tried to emulate, right? I have people on my staff and partners that are out there, like even today in conferences, going to closed door dinners with deal operators and other family offices, understanding where they're getting deal flow from, what they're investing in directly. This is something that I've realized that maybe is not my forte. I'm more of an introvert, which maybe is a good thing at the end of the day. I think introverts are probably better at building stronger relationships, but I don't like the conference scene personally. It drains my energy doing that type of stuff. You got to be out there looking for deals and interacting with people on that level, people who are few million dollars net worth, that's for sure. A lot of that and underwriting is definitely done by the team there on that side.
Do you have a big long-term goal or end game for all this?
No, not really. I get that question asked from time to time. And when you guys ask it, I'm probably like, maybe I should have some goal. But I'm still like in my 40s and I probably am going to keep doing this for another decade. So maybe I'm just jogging, right? I'm just in a marathon, just jogging, doing my thing. And to me, the thing is just look for good deals, underwrite them, get to know the person doing the deal so that you know that you're doing business with good, honest people, and just find a deal every quarter to invest in. And, that cadence may change more frequently, less frequently. Again, like going back to what I said about market cycles, you never know when a market cycle is going to be. And I hate to quote financial planners on this, you dollar cost average. So I always want to be going into deals. Now, I think previously it was all commercial real estate, but I think in the future, maybe I want to sprinkle in some private equity, venture capital, which are way more riskier, have potential for higher returns, but I think from my perspective are at least uncorrelated with each other. And the next time commercial real estate goes down, maybe the other sectors that I'm in aren't really impacted too much. I will say that I personally follow a barbell approach in terms of investments, where a lot of stuff I do is, for most people's viewpoints, pretty risky. Although we take a look at the numbers and we do sensitivity analysis, and I feel confident. And obviously, I wouldn't be doing what I'm doing if I didn't feel a certain level of confidence in this. But I have stuff that are more on that riskier side, asymmetric side, and then a bunch of stuff on the low risk, low return side, such as life insurance, or maybe people who do like T-bills would go on that side, or closed-end funds is another tactic that wealthy people will do to convert their net worth to cash flow in a little bit of a tax advantage way. I personally don't do that. I like life insurance as my method of achieving that side of that barbell. But yeah, that's what I do. I'm not giving any financial advice. I'm not a certified financial planner. Apparently, I would have to charge people to do that and also sell them marketable securities. That's where I'm heading in the future. The reason behind this, I'm going to talk about real estate a little bit. I'm still going to do real estate. Don't get me wrong, but for a lot of other reasons. But we just came out of an interest rate environment the last decade of pretty much free money. Howard Marks had some remarks about this too recently, where there's been a bit of a changing of the guards after the summer of 2022. That was when interest rates started to shoot up. Everybody talks about interest rates going back down, and they are, but I don't think that the Fed rate is going to go under 3%. And I'll be the first one to tell you I don't know, but I'm just going off of the data that all industry professionals have, which is the Chatham Financial Curve or the CME FedWatch. Like right now, everybody listening needs to bookmark those two pages. Again, those are the Chatham Financial Curve and the CME FedWatch tool. These people are the people who sell insurance on the rate caps for commercial operators like us. Suffice to say, they have some skin in the game. But yeah, these two tools are like the best thing we got out there. And they're not saying that the interest rates are going to come down under 3% anytime soon. So we lost a big trade win to investing in real estate. And when you combine that, the fact that now expenses are a hell of a lot greater, insurance just doubled, taxes just doubled a lot of these properties, and debt service is going to be at this elevated level. Geez, like how do you make this stuff work? Of course, every deal that you do should be a special snowflake, right? That bucks the generalities of this. But I think those people who were real estate fanboys, such as myself, lost a big trade win to our back. Again, still going to do it for other reasons, but I looked at myself from in 2023 to 2024 as a bit of a soul searching. Where is an investor going to get alpha? Is a question you need to ask. What asset class? What's the business plan? And you no longer can just buy and hold your way to financial freedom. Like I'm sure the audience have heard this concept of turnkey rentals, because that's what I started with. And that's what people on the first floor of the wealth elevator should do. These turnkey rentals are, you buy a house, you don't do too much to it because you don't want to take too much risks on the construction side. But when I was first buying this stuff, I was buying it for 60 to 80 grand per property per unit. And I was able to get $800 a month in rent Fast forward to today, that same property is like $140,000 with hell of a lot more interest rate, taxes, insurance. It just doesn't work anymore. So you have to go to a more audacious business plan. I think that's what we were doing. Like we were renovating these apartments, but you can't just do lipstick on a pig. It now pushes you to maybe even ground up construction. Or I think that's what led me to now buying businesses, private equity, and these other more audacious investments that, yes, they are a lot more riskier. The water level in the harbor just got a lot higher, and what got us here isn't going to get us to where we want to be.
If you could have dinner with 4 people, living or dead, who would they be, sir? 5.
Okay, 4 people living or dead. So to help my real estate, I want to pick the brain of the Fed chair. I want to understand if they really are freaked out if Trump is going to kick them out and where interest rates are really going, because real estate is highly correlated where interest rates go. So there's a few pointed questions I would like to ask just for my own understanding on that. The next person I would like to talk to is the people who are at the top of JP Morgan and Citi, like these investment banker houses. In when a stock goes IPO, I think that's what everybody sees, but people don't realize that a lot of these firms will invest with these companies more early stage. Maybe not as early as an angel investor will invest on the seed round. Like I prefer to invest in companies once they're making revenue. That's why I like to buy apartments, because I like to see the last 2 years of financials. It sure makes it de-risks a lot of things and gives me a little bit more certainty in an uncertain world. I think there is some things that like the large institutions have a huge advantage. At the same time, the large institutions have a lot of overhead, a lot of people to pay. And I think that goes back to my, like, why as an investor, I like to try to cut out the middlemen and invest more directly. Maybe that means I can ultimately save money in terms of fees and carried interest by doing it that way. I get that side of that more institutional investment house on the way that they're thinking about things. Maybe it's somebody at Blackstone or something like that. Real estate's tough, right? Like I said, prices are a lot more elevated. So you got to make sure you underwrite your properties well. Maybe real estate isn't for you, right? Maybe you skip to bigger projects. Check out my book. If you guys buy my book and email me the receipt, I'll hook you guys up with the PDF and MP3 version. But I think that's the first thing. You got to figure out what floor of the wealth elevator you're at first, because some people don't make that much money and they need to just focus on getting a better job and saving more money and budgeting. Some people are definitely ready to skip over single family homes because single family homes isn't going to get you the financial independence. If you really want $10,000 to $20,000 of passive income a month, you're going to need damn near 40 or 50 of those things. And that is just not sustainable. And you'll probably get sued a couple of times every single year for some frivolous thing that'll drive you crazy. So yeah, that's the first thing, is figure out what floor you're on the wealth elevator first, because the strategy is predominantly dictated off of that. Yeah, thanks for having me, guys.